When stocks are making new lows, inflation refuses to calm down. Deposit rates are being cut. Taxes are creeping higher, and every headline screams crisis. The natural question is simple. Where do I actually put my money? If I lost everything today and had to build an anti-crisis portfolio completely from scratch, how would I do it? That's exactly what I want to walk through with you. I've been investing my own money since before the global financial crisis, and one thing I've noticed is that in a crisis, it's not the smartest or bravest investors who survive. The ones who usually make it through are the fastest, who take risk off the table before the real panic, the most diversified, who don't keep all their eggs in one basket, and the most conservative, who don't over-leverage and don't bet the house on one story. The people who lose the most are those who go hunting for easy, magical solutions right when the world is on fire. Exactly in crisis periods, a whole zoo of perfect schemes appears. Guaranteed high yields. Instant transfers with almost no fees. Secret ways to move money around the system. Shiny new crypto projects and DeFi platforms that promise the moon. On paper, it all sounds efficient and clever. In real life, it often ends with frozen accounts, blocked withdrawals, legal trouble, or simply the money disappearing. In the past, I actively used peer-to-peer transfers. Today, in many countries, that's exactly where the dirtiest stuff happens. Stolen cards, fraud, money laundering. And if you accidentally sit in the middle of that chain, the authorities don't come for some abstract scammer. They come for the person whose name is on the account. So now, if I work with crypto at all, I prefer regulated exchanges and brokers in clear jurisdictions like the United States, the European Union, or the United Kingdom, where compliance is boring, but at least it's legal and transparent. In a crisis, boring and legal beats fast and magical every single time. The biggest mistake I see in crises is not picking the wrong stock or entering at the wrong moment. The biggest mistake is panic selling at the bottom. The pattern is almost always the same. The market is falling. Headlines shout recession, crash, war, system is broken. Stocks are down, bonds are down, sometimes even gold is flat or falling. You open your brokerage app, see a red number with a minus sign, maybe 30, 40, 50%, and your hand reaches for the sell everything button. At that moment, you do several things at once. You turn a temporary drawdown into a permanent loss. Before you sold, it was just a number on the screen that could still recover. After you sell, the loss is locked in. In many countries, you also give up future tax benefits that reward long-term holding. And most importantly, you remove yourself from the recovery. When the market bounces back, whether in a sharp V-shape like after the pandemic crash, or slowly over several years, your capital is no longer in the game. You are sitting on the sidelines in cash, watching prices move away from you. Sitting entirely in cash feels safe, but it's not as safe as it looks. Cash does not produce anything. There is no cash flow. Inflation quietly eats its real value month after month. And psychologically, it is very hard to re-enter the market. The news is still scary, the memory of losses is fresh, so you keep waiting for the perfect moment, and by the time you finally dare to buy again, a large part of the rebound is already gone. So if selling everything and hiding in cash is a bad strategy, what am I actually trying to protect myself from in a crisis? When people say crisis, they mix together very different scenarios. For a long-term investor like me, several things matter. We can face a long bear market when stocks drift down or nowhere for years. We can get a sideways market where prices just chop up and down in a range with no clear trend. We can get high inflation when the nominal numbers look okay, but the real purchasing power of money is falling. We can see our local currency weaken strongly against the dollar or the euro. We can get a sharp crash followed by a fast rebound. And of course, we can also get the simplest scenario, a long bull market where almost everything just grinds higher. Different assets react very differently to each of these situations. That's why there is no single magic investment that saves me from everything. But there is a way to combine several types of instruments, so that, whatever happens, some part of my portfolio is doing its job. That's the core idea of an anti-crisis portfolio. One classic building block is real estate. Most people think in terms of buying a whole apartment or house, but even with relatively small capital today, I can get exposure to property through real estate investment trusts, real estate ETFs, or fractional and crowdfunding platforms that pool many investors into larger projects. Real estate can be a good anti-crisis tool because it generates rent. When stocks are cheap and everyone is panicking, tenants still need a place to live or work. Rental income can help me pay my bills or buy underpriced financial assets without selling at a bad moment. Over the long term, real estate is also a decent inflation hedge because incomes tend to rise, rents follow, and property prices adjust upward. Real estate has its weaknesses. It's illiquid, very local, and individual properties require maintenance and management. But if I use diversified funds or trusts instead of one single apartment, it becomes a solid defensive piece in scenarios like high inflation, long bear markets, or sideways markets where stocks do nothing for years. Another classic defensive piece for me is gold. Gold does not produce cash flow. It does not invent anything, pay dividends, or launch new products, and that is its weakness. But it has two important strengths. Its price is usually quoted in strong currencies like the dollar, so it can help when my local currency weakens. And it tends to do well in periods of high global inflation or systemic fear, when trust in paper assets and governments falls. As a US or European investor, the easiest formats are gold ETFs, allocated gold accounts, or physical gold stored professionally in a vault, not under my pillow. I don't treat gold as the engine of my wealth. For me, it's more like an insurance policy against currency crises, loss of trust in central banks, and long inflationary periods. I'm fine if it just sits there and does nothing for years, because in the scenarios where it is needed, I'm happy to have it. Then there are bonds and cash-like instruments. This is the part of my portfolio that behaves a little bit like a salary coming from the market. Bonds pay regular interest. I can build a ladder so that some bond is always maturing and paying me back. Or I can just hold high-quality bond funds that distribute interest. In developed markets, I have government bonds, investment-grade corporate bonds, inflation-linked bonds that adjust with the price level, and floating-rate bonds whose coupons move with interest rates. On top of that, there are money market funds, short-term bond ETFs, and high-yield savings accounts that behave almost like cash, but with some yield. With a smart mix of these instruments, I can cover long bear markets, sideways markets, inflation spikes, and even some local currency risk if part of my bonds are denominated in stronger foreign currencies. For many people in the US and Europe, a big part of the defensive side of the portfolio can sit in short and intermediate-term government bonds, strong corporate bonds, and money market funds. They are boring, but they give stability, predictable cash flows, and a buffer when risk assets are swinging. And then we come to stocks, the part that secretly excites most people. If real estate, bonds, and gold are my defense, stocks are my offense. They are the part of the portfolio that says, at some point the fear will pass, businesses will go back to earning money, and human progress will continue. Inside equities, I think of two broad groups. Growth companies that reinvest everything to expand faster, often with little or no dividends. They tend to fall the hardest in crises, but can explode upwards in recoveries. And dividend-paying companies, more mature businesses that regularly return cash to shareholders. They usually fall less than aggressive growth names, and their dividends can act as a partial inflation shield, because many firms gradually raise their payouts over time as revenues rise. Historically, equities are the main engine of real long-term returns. Over decades, broad stock indexes have beaten both inflation and cash by a wide margin. But to benefit from that, I have to accept volatility as the price of that growth. I have lived through periods where my stock portfolio was down by a third or more on paper, and then recovered and made new highs. I had individual positions that fell heavily, then later were up more than double from the lows. If I had sold at maximum fear, I would have locked in loss and missed the rebound. So in my anti-crisis structure, Stocks represent the scenario where the world doesn't end, innovation continues, and markets eventually move higher again. Now let me say a few words about crypto and decentralized finance, because they are always part of the discussion. My attitude here is split. On the one hand, in countries with capital controls, failing banks or unstable currencies, people often use major coins, and especially stablecoins, as a way to move money across borders, bypass local banking restrictions, or diversify away from a weak local currency. In that narrow sense, certain crypto tools can act like a tunnel to send money from point A to point B when traditional channels are blocked or unsafe. Used responsibly and within the law, that can be very practical. On the other hand, as an investment, crypto is extremely volatile and heavily driven by sentiment, liquidity cycles, regulation, and narratives. Bitcoin has a limited and slowly growing supply, while fiat money supply is constantly expanding, so on paper it looks like a digital hard asset. In practice, it goes through brutal boom and bust cycles and can drop far more than most people can stomach during a bear market. It is not a stable store of value in the way beginners imagine. For me, crypto is not a core defensive asset. At best, it is a small, speculative satellite allocation that I can completely afford to lose. Stablecoins are a technical tool for transfers, not a long-term savings vehicle, and if I use crypto at all, I prefer regulated exchanges with proper checks, and I treat the money there as high risk, not as the foundation of my financial security. So how do I combine all these pieces into something that can survive multiple scenarios? I start from a few principles. I want diversification across asset classes, so I'm not all in on one story. I want some currency diversification, so I'm not fully tied to a single national money. I want a balance between offense and defense, between assets that protect me in bad times and assets that grow in good times. I avoid excessive leverage because debt is what kills people in crises. I add regularly, especially during downturns, because new contributions in bad markets are one of the most powerful tools I have. From these principles, I can build many possible structures. For example, I might put roughly 2/5 of my capital into growth engines such as global stock index funds, a couple of quality dividend ETFs, and maybe a very small slice of crypto if I really want that optionality. Around 1/3 could go into defensive income, government bonds in strong currencies, solid corporate bonds, money market funds, and short-term bond ETFs. The remaining quarter might go into real assets like diversified real estate funds and some allocation to gold. This is just an illustration, not a recommendation. The idea is simple. If markets crash but later recover, the stock part pulls me back up. If we get high inflation, real estate, dividend stocks, and some gold help. If we get a long stagnation, bonds, cash-like instruments, and rental income keep me alive. If my local currency weakens, foreign assets and gold cushion the blow. My goal is not to predict the exact future. My goal is to sleep at night without caring too much which one of several plausible futures we get. Because the world is becoming more complex and faster, I also use something like a barbell in my own approach. I keep the large majority of my capital in relatively robust, cash-generating and diversified assets, broad equity ETFs, defensive sectors like food, basic healthcare and utilities, quality bonds, real estate. Then I reserve a small part for high-risk, high-potential bets directly tied to the emerging economy, artificial intelligence, robotics, cybersecurity, and some deep tech areas. In my mind, AI is the brain, robots are the hands and feet, and cybersecurity is the immune system of the new world. The logic is simple. If the world just muddles through, the boring 90% style side keeps me safe and growing steadily. If the new technological wave creates massive winners, that small aggressive slice has a chance to multiply enough to move the needle. On that aggressive side, I only want positions where the potential upside is many times larger than the downside. If I put a modest amount into a high-risk stock or project, I'm prepared to lose it. But I want a realistic path to several times my money if things go well. In a more chaotic world, I assume I will be wrong quite often. So the few big successes must more than pay for many small failures. That's what people mean when they talk about optionality. If you are an entrepreneur or self-employed, there is another dimension. Many business owners make the same mistake. They keep almost all their net worth tied to their own company. It feels logical because they control it, they understand it, and their returns have been highest there. But a single shock, a regulatory change, a technological shift, a geopolitical event, a key partner leaving, can wipe out years of work. I think of two different goals. Economic freedom is when my income is high enough to afford the lifestyle I want. Economic security is when that lifestyle is supported by income streams that do not depend on my health, my country, or my main business. Most entrepreneurs chase freedom and then live with a permanent low-level anxiety. What if the business slows down? What if I get sick? What if this model stops working? That anxiety is a signal that economic security is not yet in place. For me, the logic is to use my business to reach freedom and then deliberately redirect a portion of the cash flow to build an independent investment portfolio. When that portfolio alone could support my basic standard of living, I'm economically secure. After that, any extra surplus can go into philanthropy, passion projects, or higher-risk experiments. Now, should we be afraid of crises? Should we sit in cash and wait until everything calms down? I see it differently. A crisis is simply the moment when my mental picture of reality stops matching actual reality. I thought the world worked a certain way. Suddenly it behaves differently. The gap between those two pictures is the crisis. If I'm unprepared, with no savings, no diversification, and no understanding of how things work, any shock feels like the end of the world. If I am prepared, with a thought-through diversified portfolio, some liquidity, a clear plan and scenarios, the same crisis looks very different. It becomes a sale. It becomes the moment when good assets are marked down because everyone is scared. It becomes a stress test of my discipline, not a death sentence. I like an aviation analogy. When a pilot flies into a cloud, they lose visual reference. It feels scary, and the instinct is to do something dramatic. But the key rule they learn is simple. Keep flying the plane. Do not let go of the controls. Do not freeze. Do not start pulling the stick wildly. In investing, it is the same. In rough weather, I keep following my process. I keep contributing according to my plan. I rebalance when necessary. And I remind myself that every storm ends. The real question is not whether there will be another crisis, but in what shape I will be when it is over. There is one more element that connects all of this, and that is artificial intelligence itself. AI will penetrate finance, law, medicine, education, logistics, and creative work. Some people hope AI will simply make them rich. Others fear it will take all the jobs. My view is different. AI will not replace my ability to think. It will amplify whatever is already there. If I ask shallow questions, I will get shallow answers and I will stop thinking for myself. If I ask deep, precise questions and use AI as a partner, it will push my thinking to a higher level. In that sense, strong minds become stronger with AI. Weak minds become weaker. So the most important asset in my personal anti-crisis portfolio is not gold, not bonds, not real estate. It is my own ability to learn, to think, and to adapt. Putting everything together, an anti-crisis approach for me looks like this. I refuse to chase magical schemes and shady shortcuts. I refuse to panic sell at the bottom. I build a diversified portfolio where stocks are my main growth engine, bonds and cash equivalents act like a salary from the market, real estate and maybe some gold protect me as real assets, and only a small conscious slice goes into high-risk experiments like crypto or early-stage tech. I use a barbell. Most of my capital is in robust assets, a small piece in high-upside opportunities. If I run a business, I separate economic freedom from economic security and use investments to build that security. And above all, when the world goes crazy, I keep flying the plane. Nothing I've said is personal financial advice. I'm sharing how I think about risk, diversification, and the future. Your situation is unique, and before you make big decisions, you should do your own research or talk to a qualified advisor who knows your specific circumstances. But there is one thing I'm sure of. Crises will come and go. Technologies will change. Currencies will rise and fall. The people who win over the long run are not the ones who guess the next headline correctly. They are the ones who prepare, diversify, keep learning, and stay in the game long enough for compounding to work in their favor. Thanks for watching. Please like if you found this helpful, leave a comment, be sure to subscribe, and share this video. You can find useful links in the video or channel description. See you soon.